Where did you?
John Rubino, gold and silver are setting up for a nice first-half rally. John says precious metals investors don't have much to console them these days, but the setup is pretty bullish. Here are the details by Own Rubino. All collapse. Precious metals investors don't have much to console them these days. Just about the only bright spot is the nice, though ephemeral, pop in the gold-silver price that seems to happen every January. Sometimes it persists for 6 or so months, sometimes it ends before the snows do. But either way it's more fun than the rest of the year. This pattern repeats because Asians like to give gold and silver jewelry as wedding gifts, and they like to have their weddings in the spring. So they do their anticipatory buying in January, which tends, other things being equal, to push up the price. There's no reason to expect Asian buying to depart from the usual this January, so, especially given 2018's grinding price decline which has put the metals on sale, it's reasonable to expect positive trends to kick in shortly. In fact, the setup this time is looking a lot like 2016, by far the best run of the past 5 years. Because in addition to the normal seasonal factors, the structure of the paper, that is, futures contract markets, is also bullish. This past week, commercial traders, who tend to be right at big turning points, went aggressively long and are not far from being net long, meaning they strongly expect higher prices in the next few months. Speculators, meanwhile, tend to be wrong at turning points, and they're now net short, which is also both unusual and very bullish. Here's the same data for gold in graphical form, which illustrates how unusual the current structure has become. So let's fantasize a bit about a replay of 2016, when both gold and silver rose for a solid 6 months, and recall the fire that lit under the mining stocks. Here's Silver Miner ETF SIL, one of many fond memories that would be nice to revisit.
John Rubino, the paper gold and silver markets are screaming short squeeze. John says there are 2 possible explanations for what is going on in the paper gold and silver markets. Here are the details. By John Rubino of Dollar Collapse. Every once in a while the trading action in a given market breaks through its historically normal boundaries and starts exploring new territory. This can mean one of 2 things: either something fundamental has changed, creating a new normal to which participants will have to adapt. Or the extreme move is a temporary aberration that will eventually be corrected by an equally extreme snap back into the previous range. The gold and silver futures markets are posing this kind of question right now, with speculators, who are usually net long, going net short, and commercial traders, who are usually net short, going net long. The following table shows how each group traveled even further into this unfamiliar territory in the past week. The following chart illustrates how unusual this new market structure is. During most of the past year the speculators, gray bars, have been extremely long and the commercials, red bars, extremely short. Now they've swapped attitudes, with speculators betting that gold is going to fall and the commercials taking the other side of that bet. The same process is at work in silver, where the departure from the norm is even more extreme. In other words, the speculators are very short and the commercials very long. Presented graphically, the far right of the chart illustrates just how unusual the current action is. It's possible that these 2 groups of traders have never been in this relative position before. What does this mean? Either something has happened to realign speculator and commercial trader incentives and objectives, putting them permanently on the other side of their traditional positions, or the past few weeks' action is an anomaly that will be corrected with an extreme move in the other direction. Which is more likely? The latter almost certainly, because the commercial's traditional net short position exists for business reasons. Gold and silver miners frequently sell their production forward using futures contracts to lock in a predictable price, and they place their orders through the banks that make up the bulk of commercial traders. As long as the miners continue to hedge, commercial traders will necessarily tend to be net short. Speculators, meanwhile, traditionally take the other side of this trade, because every trade has to have two sides, which means they have to be net long to make the market work. So at some point the balance has to be restored. The timing is anyone's guess, since the current market structure is virtually unprecedented. But when it happens, it's likely to be via a short squeeze in which the speculators begin to close out their long positions and find that they have to pay way up in order to do so. The resulting panic will bring a little sunshine into Goldbug's recently dreary lives.